Everybody, very big welcome to you all and thank you for dialing in today. Before I hand you over to Tim, I'd just like to give you a quick intro about me. So those who don't know me, Paul Stewart from Barrow and Bench Minor 10 in South Australia. I also sit on the national board and are currently the chairman of the board for Hardware Australia. So before I hand you over to Tim, I just want to give you a quick update on our industry and what's been happening in Hardware Australia. So I think all of us would agree that it's been a fairly positive year sales-wise, particularly for the DIY sector. But obviously it has not been easy for all of us. You know, Melbourne in particular has gone through a really tough time with all their hard lockdown for over 100 days and still trying to trade through it. So I know it hasn't been easy for them. I know SA, we had a little blip last week. You know, I went to bed on Wednesday night thinking that I'll be off for 6 days and not actually unhappy about having a bit of time at home to catch up. But then I got woken up the next morning saying, we can open. So I think the thing is all of us have had to adapt to what's going on. And while sales have been great, it has not been easy. It's been tough with the restrictions and changing the stores to suit, you know, with the social distancing. I've heard many stories how a lot of stores are struggling to get staff. So as a result, the store owners are working longer hours. So it has been tough. I think for Hardware Australia, obviously because of all the social things that haven't happened, you know, all the dinners, etc., we've really concentrated on the advocacy in the background. You know, we've been lobbying to ensure our hardware stores remain essential during the lockdown period. We've been lobbying the government to change their language. You know, obviously Daniel Andrews referred to Bunnings stores, and you know, we often hear hardware stores, we hear the wording hardware stores replaces Bunnings. So we've been lobbying to get the government to understand that we're more than just Bunnings. So really the advocacy is a really strong part of us. And also the communication to you all. I think Nat, who puts that all together, has been doing a great job in ensuring each week that you get information about the latest updates that will affect you with everything that's going on. So the other thing too this year, we've had a new website that was launched early in the year. So when you have 5 minutes, please jump on and have a look. And then we normally have our national luncheon, which I guess is what Tim has spoken to at one of our previous. We have decided, or we postponed it this year with the intention of holding it next year, probably middle of the year. But I think the thing this year, we all kind of think we know what's going to happen, then COVID comes along and has changed everything. So who knows what will happen in 2021. So let's hope the new vaccine is not too far away. So that's the basic update, I guess, for us. I'd now like to introduce you to Tim Reardon, Chief Economist. So Tim joined HIA in 2004 as the Executive Director, Government Relations, working on the Housing Affordability Summit in the lead up to the federal election. Tim then took the role of Executive Director, Tasmania, until 2007. And during this time, the builder's licensing regime was introduced, including reforms to homeowners warranty, and HIA awarded off an increase in energy efficient standards in new homes. After leaving HIA, Tim then represented the automotive manufacturers during the industry review of 2008, gaining $4.8 billion in industry assistance. He represented the electricity generators through the introduction and repeal of the carbon price in 2012, and also worked as a consultant for a number of other industry groups and companies on federal policy matters. Tim has then rejoined HIA as Chief Economist in 2017 and is heading up the HIA Economics team. So thank you, Tim. We appreciate your time this morning, and I'll hand it over to you now.
Pleasure, Paul. Thank you for the opportunity. Educate, associate, advocate. I believe I read on your website this morning. Did I get that right?
Correct.
Yeah. All right. So now I'm just going to share my screen here, and you should see pop up there. I'm going to run through a few slides today. I have quite a few here, and happy to share those with Nat to distribute after the session. But what I'm going to tell you today is a story. It's a pretty positive story. In fact, it's really hard right where we're at the moment to see the negatives of what's transpired for the home building sector, that is. We've got a really strong outlook for detached starts. So very roughly speaking, last year we were doing a little over 100,000 detached nationally, and we're probably going to do about 105 this year. So a little stronger this year than last. The outlook, of course, for multi-units is very poor, but we also have a really strong renovations market across the country. There's a few issues when we look beyond the next 12 months, but hopefully the strength of the national economy will pull the home building sector forward out of that a downward cycle in that 2022 timeframe. I'm going to talk today a little bit more about renovations than I have in the past. Renovations is really hard to forecast. It does make up it's about half the number of people employed in the renovations market as are employed building new homes. So it is a really important component to our economy. And at the start of COVID, we had expected that a rise in unemployment, a fall in incomes was going to cause people to spend less money on their homes. Of course, we're wrong. We're just astronomically wrong in that. In fact, what we've seen is quite the opposite. If we look at this slide here, and apologies for the colour there, but if you look at that, that's expenditure largely through hardware stores over the course of the past decade. And usually we're looking at, maybe 1% change in expenditure at hardware stores on an annual basis. And this year we've seen a 25% increase in expenditure. So now that's small scale renovation. And we break renovations down into three different categories. Small scale being mum and dad's repainting, changing a kitchen, door handles and the likes. There's been an enormous volume of that going on. I'll come back to the reasons why in a minute. But one of the key reasons is what people have done is they've switched from spending on travel and entertainment to spending on their house. And of course, the reasons for that are very simple. They couldn't spend at restaurants and travel, so they have spent on their house. They have been at home looking at all of those things that are broken, and they've been getting them fixed. We've lived in the same house for 15 years and our front doors never worked. And my wife's been working at home since March, and every problem in our house has now been fixed. And I think it's true of every home in Australia that surge that we've seen was certainly unexpected for us. I'm going to come back to renovations a little further on, but if we break it down into those three components, small scale renovations up by about 25%. Kitchens and bathroom renovations, which typically happen at around about 25 years of age of homes, were expected to slow. But what we've seen this year is that there were very few established homes transacted. So the number of homes being bought and sold fell significantly, which means over the course of the next 12 months, all those people that delayed either upsizing or downsizing, they haven't gotten younger. They're still needing to change to make those life decisions, which means we get a catch up of kitchens and bathrooms activity, those medium scale renovations. We get that catch up over the course of the next 18 months. And then we have the large scale renovation projects, which are going to be backed by a home builder. So all of those, we should see an upward movement in renovations. And so in that graph on renovations forecast there before, we have around about a 6% increase in renovations activity forecast for the year ahead. Now, I would say that when we look at that number in 12 months' time, we'll quite possibly find it was well beyond that number. I don't think that there's any risk that we're going to undershoot that renovations number. I think there are only risks that we will go beyond that. And I think it's also true of our detached forecast as well. I think I think that there is a lot of opportunity for the economy to do far better than people have expected, and for us to pull out of this over the next 6 months very quickly. This is a headline forecast going through to 2025, and you can see that we're forecasting a slowdown in the number of homes to be built. But it's important to distinguish that when we split that between apartments and houses, all of that pain is in apartments. It's not in the housing sector. So we're looking at detached starts this financial year at just under 105,000 starts. As I mentioned before, last year it was 102. So a small pickup. Now, most of that pickup, most of that net gain is actually west of the Victorian South Australian border. Those markets are doing exceptionally well over the course of the next 12 months. a lot of people are focusing on this number here, 94,000 starts in 2021-22. And again, I'm going to say that I think that there are only upside risks to this. The assumptions that sit behind that are that we won't have migration next year, and in fact, it will be negative, and that we get a relatively slow rate of growth recovering, and that there is the end of home builder at the end of March next year. Now, what we've seen is that those population dynamics do appear to be quite different from what we have in terms of the government's assumptions on population growth. And I'll come back to that. But if we see a return of migration early next year, then we will certainly be seeing that number there increase. Every time there is a government program, such as Home Builder, a stimulus program, we do see a hollow on the other side. And we will see a hollow on the other side of Home Builder, not just because of Home Builder, but also because of the change in demographic shifts. It's difficult to work out the exact number of projects that Home Builder has funded to date. This is the government data of the number of applications that have been lodged. And one of the very curious anomalies is that Victoria, whilst having been in lockdown for the longest and having the most severe restrictions, have seen the largest number of applicants for Home Builder. In fact, almost double the number of applicants in Victoria for new homes compared to New South Wales. These are renovation projects in red, and these are new housing starts in green. So back to that renovations forecast of a pickup in activity, it appears the more time people spend at home, the more time they're forced not to go to restaurants and take holidays, the more money they spend on housing. And Victoria is a good example of that. The response here in Queensland, I'll come to in a moment. But the question then is, we've got this strong demand coming through, and where's it coming from? It's coming from a change of consumer preference. It comes from a deurbanisation of our cities. It comes from sea changes and tree changes making major life decisions. We're seeing ongoing demographic demand from migration and population growth over the past decade. By that, I mean there's a lag. We don't see detached house moving to annual changes in migration. It takes about 3 to 5 years to come through to us. We're seeing a large number of expats returning to the country, and there are a series of individual household responses that if you didn't lose your job in this shock, then what you're looking at is lower interest rates, government stimulus programs either direct to your income or through wider economic activity. And the last one, which is one that I think is one that we're looking at in the course of November, which is the credit squeeze, which has hit the industry over the past 2 years, I believe is easing right at the moment. The introduction of the legislation, the responsible lending guidelines that the government did early in November, has been the cue for banks to change the way in which they lend money, the way in which they assess particularly first home buyers. First home buyers were forced out of the market in 2018 as the Royal Commission and all of those regulations came into place. The banks have now recognised that they are not legally bound to follow those guidelines, and the government has written legislation to ease those guidelines, and the banks have moved ahead of that legislation. So I just put it out there to builders that may not be the same issue in November as what it was, say, in September. Now, this is one of those key factors that are driving driving demand for detached houses at the moment. And it's what we've seen this year is a very sharp movement out of, and this is almost exclusively Sydney and Melbourne. It doesn't exist in Perth, Adelaide, Darwin, Hobart, but a very sharp exit out of those cities. Now, you can see here there is always an exit out of capital cities to the regions. And a large part of this decline isn't people leaving, it is that country kids haven't gone to Sydney and Melbourne to get a job or go to uni in 2020. That means all those regional populations have more people in them than what they've had before, which is why at the moment you're seeing record house prices set for regional areas all the way across the country. Sunshine Coast, Canberra here, just clocking up record suburb house prices. Look at regional Victoria, South Australia, Perth hasn't quite hit it yet, but it will come very soon. Now, those kids moving from the country to the city didn't move in 2020. They're not going to move in 2021. So there is a lot of economic activity occurring outside of Sydney and Melbourne. We can see that in this graph here, which is that shift in population that typically occurs. And I'm using the phrase deurbanisation. Since the end of the Second World War, we've seen the Australian population move out of the regions and into Sydney and Melbourne very much. A little to Brisbane, but Brisbane sits about on average with the nation. So the issue for us will be, when Sydney and Melbourne are back up and operating, how many of those people that left Sydney and Melbourne and moved to the rest of the country, and how many of those kids that haven't moved to the city over the past 2 years make the decision to move? How much of a hollow is there on the other side? Now, our expectation is that probably 85% of them return to that trend, but about 15% of them will stick in the regions. And I should say regions are everywhere other than metropolitan Sydney and Melbourne. I'm talking about the suburbs from Essendon to the city or Bankstown to the city. So that will leave a little bit of a hollow on the other side for the regions, but over the course of the next 2 years, simply the higher population in those areas will see a higher rate of economic activity. Change in buyer preference. So we did a little survey earlier in the year and asked our members, what's COVID done to the type and nature of houses? And not surprisingly, if you live in an apartment, you're seeking out a medium density house. If you live in a medium density house, you're seeking a detached house. If you're living in the suburbs, you're looking to move to a more rural environment. And so we have a significant change in consumer preference for the number of living spaces in a house. That 1980s style rumpus room is back in vogue. And the apartment builders will tell you that the only apartments that they're selling at the moment are those that have a study that lends itself to being able to do Skype interviews without being able to see the kitchen in the background. So it has had a shift in terms of consumer preference. I'm going to skip over the pressure points for the moment. I'm now going to, I haven't covered off the other factor around the stimulus, and households do have lower interest rates. JobKeeper, Job Seeker, there was talk early of a fiscal cliff, but the GFC, we saw the government go hard, go early, go households. Whereas this time they've gone very heavily in a slower mechanism to distribute that wealth, which is to go business, which goes income stream and ends up with households. What households have done with that is they've largely saved any additional income that they have received through the course of the past 6 months. Possibly because they couldn't have spent it anywhere. But the bank data shows us that whilst credit card expenditure is up 8% over the course of this year, so too are people's expenditure on paying down their mortgage or putting more money into their mortgage offset account. So I don't think there's a fiscal cliff coming any time in the next 12 months. And I don't think we'll get it any time before the next federal election. And that's because this budget that we've just had is highly stimulatory. The budget between now and May, when we see the next federal budget, we have all the state budgets, and you can see from New South Wales and Victoria and Queensland, they're all highly stimulatory. The May budget next year won't be one where the government starts to draw back on that expenditure. They're going to keep spending their way through this cycle until the next federal election, which I suspect is either the end of next year or early 2022. After that may be the point at which we start looking at all of that, well, having to repay that debt. I'll come back to that in a minute. I'm going to run you through our latest data on housing. So Google Index, of course, is showing us that consumer confidence is very strong. Our own internal contracts data shows us that August was the strongest month we've had on record, which was followed by September being the strongest month on record. October is a very strong month. Things have eased a little in November, but nothing remarkably so. We're seeing a really strong surge in the number of projects coming through. This is the first piece of ABS or official public data showing this home builder wave coming through. And you don't need a degree in economics to be able to read that that is a really good news. That is the highest number of approvals for loans for the building of a new home ever. And it's not by a small margin. And we know that September wasn't the biggest. We know that October is going to be bigger than September for our own internal data. And November won't be poor. So we're probably not going to see this peak come down until early next year. It's not, and when it does, it's coming back to some quite solid levels. When we look at our new home sales, which is the next piece of leading data we see, you can see here we've now sustained 5 strong months of sales. I haven't seen the November data to date, but I would expect that we're going to start seeing this peak here fall off. And that's just the ending of that home builder wave. Builders at this stage won't be able to commit to commence a new project before the end of March next year. And as a consequence, we're just going to see a few more consumers fall out of the market. It's not a problem in that they will be the consumers that return around about this time next year, probably without government support behind them. But still, when you look back at the history there, that 5 solid months, admittedly, it's picking up from 3 very poor months, but it's been sustained for a number of months. I'm going to track through a little bit of detail in terms of each of the individual states now. I'll do it reasonably quickly. Victoria, of course, took some time to see a pickup in activity due to home builder, due to the additional restrictions they had there. But in October, we saw a very strong response. In fact, we've seen a stronger response in Victoria than we have in New South Wales. In terms of our forecast, though, for Victoria, we remain reasonably pessimistic about, and I will say Melbourne, not Victoria. And that's because Victoria for the past decade has been very reliant on population growth. 2% population growth for a decade is really quite exceptional. It's unlikely that on the other side, they're going to get back to that rate of population growth, which just means we see Melbourne coming off that peak and that there isn't the volume of expenditure in infrastructure and construction that's going to hold that up. We need to keep in mind that these 38,000 starts back in 2016-17 were the anomaly. That is an enormous number of starts for Melbourne, and 30,000 starts is in fact close to the long-term average for Melbourne. And you'll start getting back to that. So we don't have a scenario in Melbourne that sees you getting back to those boom levels anytime in the next decade. When we look at WA, though, we get a very different story. Once again, very simply, new home sales with the announcement of home builder jumped 100%. We'll argue as to whether they're 130% or 150%, but the pent-up demand that existed in WA prior to the COVID shock, the market was ready to go in 2018 when the credit squeeze hit it. It was ready to go early this year when COVID hit it. And home builder, the state government initiatives, all of those measures have come through, and this market is now pulling out of a very deep, dark cycle that they have been in since 2014. Now, even with that strong level of activity, they're not getting back to the level of detached housing starts they had back in 2014. But I do think that there's probably an upside risk to this 13,000 forecast. It's a good chance that if you can find enough people to build homes in Perth, that you will get well beyond that. And I think it is the restriction on available land and restriction on people to pour slabs that will be the greatest impediment to going beyond that 13,000. There's a limit to how quickly a market can grow in just 6 months. But of course, what are we looking at? 5% rental price growth in the September quarter this year in Perth. You annualize that and you're looking at more than 50% increase in rents year on year. So there is a lot of pressure. There's simply not enough homes in Perth to meet ongoing population growth, let alone that shift in population that I showed you before. South Australia is a similar story to Perth. Those graphs I showed before of the shift out of Melbourne and Sydney, for the first time this century, South Australia has positive population growth. South Australia typically exports 6,000 skilled workers a year to Melbourne, and this year that stopped. I suspect next year it stops as well. And some of them will lay roots in Adelaide or in South Australia. And as a consequence, we're starting to see this structural shift up. And I'm not sure that South Australia sees the downside to this. This is a shift upwards in population that will be sustained. So when home builder ends, I don't think that we see Adelaide falling off the other side. I think that we see a stronger level of underlying economic activity there. So this is the home builder peak that we can see coming through here. Like South Australia, like Western Australia, the capacity constraint will be the ability to start new homes, not demand. And then you'll track back to your long-term average of building 8,000 homes per year. You can see, I haven't focused on multi-units to date, but you can see there the decline across the years for South Australia, and you'll see a similar trend for all regions now. That 5,000 starts is an anomaly, and it will take some time before South Australia gets back to building multi-units. Queensland, around about the average of all of the states. We've seen reasonably strong new home sales in a market that was fairly quiet. And we have a forecast which lays out a reasonably strong outlook in a market that's been fairly unremarkable. And part of that is that you have to split Queensland into two. North Queensland is away. The Adani projects are being funded. You can see the migration shift in North Queensland. The first rail project contracts are being issued up there. If you had some spare cash to buy investment homes at the moment, I would have a good look at Townsville and Perth. Townsville will move before the other states, and we're starting to see some strong activity in that region. Of course, Cairns is a very different story, and Cairns has some way to go before we see the bottom of their cycle. But in the southeast corner, this decline in multi-unit starts will eat away at activity. So a large number or a large share of your workforce were employed in building apartments in the Gold Coast region, and that loss of employment in that sector will drag down on economic activity. But on the other side, that intra-state migration and the interstate migration, we're still seeing people leave Sydney and move to the Gold Coast to retire. And in fact, probably more than what we typically would have seen. So if you had a plan to retire to the Gold Coast in the next 3 years, if you found yourself unemployed in this cycle, then you're probably taking that opportunity right now to move. We've seen over the course of the past decade, the average age of retirement get very close to 70 for white collar workers. And for those people, they're probably the ones that are going to be occupying those apartments that have been built in Brisbane over the past couple of years. Admittedly, you're at the bottom of an apartment cycle. And so we see that recovering reasonably quickly. The bottom of your cycle is for apartments is not far away at all. I've skipped over New South Wales to the end, partly because these numbers here for new home sales are very heavily dominated by the volume builders. And home builder has really not been of benefit to Sydney due to the house price caps. And so there are, when I talk to builders, they'll tell you that around the country, 80% of new home builds are backed by home builder, unless you're talking in Sydney, and it's about 20%. And it's unlikely that Sydney is going to see that home builder surge. Having said that, there is really strong demand in Wollongong, the Hunter, the Capital Region, Wagga, anywhere north of Newcastle through to the Queensland border. So the rest of the state is holding this number up. It's not Sydney. So we do, a little like Victoria, have a reasonably pessimistic forecast there for detached housing starts, keeping in mind that this 30,000 starts was an exceptionally strong period, but not declining significantly in the years ahead. Like Victoria, we're not going to see multi-unit starts occur until we see overseas population growth. And we've seen banks restricting access to lending for apartments. They're now only recognising 50% of the rental income as demonstration of capacity to pay. And so until we get to the point where overseas students are allowed back into the country and we see tourists back in the country and they draw those workers back out of the regions back to Sydney, we're not going to see a large volume of apartments reach finance approval. The start of the year, there were predictions of 20 to 40% house price declines. And as you can see from that graph there, very little of that has emerged. A 2% decline in Melbourne is the worst that we've seen. We saw it after the GFC, we saw it with the GST, we saw it with the Asian financial crisis. Those fears that there is a housing bubble in Australia, they're just not real. And particularly for detached housing, demand continues to outweigh supply, which is why we see, and the nature of this shock, as I've explained, means that we're seeing increased demand for detached. It's possible that on the other side of this, we do see some very poor house price growth, which is not a great concern. For the past 3 years, we've seen house prices relatively stable. But what we're seeing now is fairly consistently the forecasts are for a 20% house price growth. Some are forecasting that to occur over the next 6 months. I tend to subscribe a little bit more to Westpac's forecasts, which are on your screen there now, which are saying up to a 20% increase in house prices over the course of the next 2 years. I think they've underestimated Perth here and probably overestimated Brisbane a little, but there is nothing in that to make you concerned about the outlook for detached house prices. And that's really important. It's important for our economic recovery that as people feel wealthier, they do spend more money, the positive wealth effect. Households will borrow against the value of their home to do home renovations. They'll borrow against it when they're able to travel, to buy a caravan and travel around the country. It's also really important because there have been concerns raised throughout the year around the integrity of the financial sector within Australia and the housing bubble. And once again, there is no such thing. In the first week of May this year, the government announced the ability for households to defer their mortgage repayments without consequence. As a result, we saw a very large increase in the number of loans that weren't receiving mortgage payments. At the end of September, that program came to an end, and you can see what happens there. As the program came to an end, the number of people deferring their loan also fell away to a level below where it started. When we look at who was deferring their mortgage through this period of time, almost half of them are investors. Now, investors aren't our concern. Investors almost certainly have other assets behind them. The ones we're worried about are first home buyers. First home buyers that have bought a house in the past 3 years that don't have collateral built up within their house. And if we're seeing house prices rise, then that is a significant appeasement of their individual situation. If they're forced to sell and forced to sell in a market with a rising price, then their individual financial consequences are quite minimal. They may lose some money, they may lose their stamp duty, but they're not losing hundreds of thousands of dollars. We're not looking at a scenario like the United States during the GFC. We're looking at a short-term aberration. And just recently, the CBA released their data on those loan deferrals. And you can see the vast majority have returned to full payment on the date that the government free pass ended. And this is the one here that we're interested in. These are the share. So Commonwealth Bank holds about 1/3 of all home loans in the country, and 0.1% of those home loans are what's called impaired, meaning no payment has been made on those loans for 3 months. You can assume a reasonable share of that 0.1% are people that don't owe a great deal of money. So 60% of Australians don't owe very much money on their mortgage. And the people that haven't made a payment over the past 3 months have almost certainly lost their income. And they are the households that are bearing a disproportionate burden of this recession. But at 0.1%, given that the United States started the GFC with 7% impaired loans and finished with 33% impaired loans, we're finishing this cycle with a 0.1% impaired loan. Anyone that mentions a housing bubble or falling off a cliff needs to spend a little time having a look at some of the numbers that sit behind the housing market. Another factor that why we're seeing really strong demand for detached housing is first home buyers. They're very active in the market. They're taking advantage of the house price stability, the lower interest rates, cash grants from government, and the fact that investors aren't present in the market, which is another fact that I haven't mentioned. what we're seeing at the moment is outside of Sydney and Melbourne, Adelaide, 6.7% rental price growth in September. Darwin, 4-point-something rental price growth. Perth, 5%. Canberra, 3% for the quarter. We're seeing rental shortages of less than 1% all the way across the country, except for apartments in Sydney and Melbourne, which means we're going to see investors return to those markets over the course of the next 6 months. And they will fight it out with first home buyers for buying that bottom end of the market. And that bottom end of the market is really important because it is the one where the majority of homes exist, and it is the one that weighs on that headline figure of how much house prices rise. So you will see outside of Sydney and Melbourne that number go up very quickly over the course of the next 6 months. The headline national figure of what has happened to house prices will be held down what's happening to units in Sydney and Melbourne. But if you watch your individual regions, you will see some strong growth figures. I think I've probably covered first home buyers at that stage. We might skip that. Wider economy, I've mentioned the next election, and it's really important for understanding what's going to happen from a budgetary perspective. When we look at the wider economy, one thing we need to be mindful of is just what's going to happen to the Australian dollar, and the same thing's happening as what happened after the GFC, which is when the rest of the world goes into recession, they need two things. They need coal and iron ore, and we're seeing those boom right at the moment. And what we've seen is that the value of the things we import have fallen by about 60%, and the value of the things we export have fallen by about 30%, meaning we're drawing in more income than we did before. The mining sector haven't changed their outlook. They're continuing to look to increase employment. And if you look at North Queensland and WA, you'll see a positive there. This isn't a 2014 boom time. It is a more sustained recovery. Tourism, of course, is a drag. And I won't go into that in any more detail other than to say it's not consistent in terms of its adverse impact when we look across the country. So it does hit Cairns, it doesn't hit Townsville quite as much. This is a very interesting graph from our perspective. This is the government's forecast growth in GDP, and just next week, actually, we get the first GDP figures. We'll get the next quarter of GDP figures. Expect GDP to have grown by the largest amount it's ever grown by. Let's say 5%, maybe 7%. Like all the data this year, everything ricochets around. We're more interested in what happens in the December quarter because we want to see a continued recovery, not a sharp bounce back and followed by a contraction. And I suspect that it will keep on going. But the difficulty is seeing this really strong increase in GDP at the same time that we see population growth slide. And one of the things we saw after the GFC was that around about 500,000 people returned to Australia after the GFC, and they almost all occupied an apartment in Sydney and Melbourne before they dispersed around the rest of the population. Now, this time around, we don't see that 500,000 people return. The GFC event was the first contraction we'd had for 20 years, and therefore we were drawing back workers that we'd lost any time since about the mid-1980s. And they came back cashed up. They came back with having sold houses and properties. They were merchant bankers and lawyers and the likes. What we're drawing back now are those workers that have left in the past decade, and they're probably coming back owing more money than they're bringing with them, and they're not coming with those assets. Best guesstimates we have at probably a little less than 200,000 coming back this year. But unlike the last cohort, they're not coming back and living in apartments in Sydney and Melbourne. They've all come back and are looking for detached houses in suburban Australia, which is another factor that's adding to that short-term pressure on the housing market and house prices over the next 6 months. Now, I think that these population forecasts are overly pessimistic. These are the government's population forecasts. They're expecting a decline in population of 72,000 this financial year, which would be an exceptional result. But I think that we're still attracting back expat Australians before September of this year at a volume that has seen the population in Australia September 2020 at around about 200,000 people more than what it was in September 2019. And I'm basing that upon the level of demand for housing. And I suspect we'll find that out when we get the official government figures. talk of when this comes to an end, this enormous level of stimulus and expenditure. This is, since the Second World War, it's the first time we've clocked up a significant volume of debt. The reason the government can do that is because during this period here, we had an insurance policy, which is the government paid off the debt. And at some stage, we do need to pay off this debt as well. Don't be overly concerned about that at this stage. Post the next federal election, we will start wearing some of that pain, but you don't see it in terms of higher taxes. There will be a reduction in expenditure, but just like we repaid this debt of the Second World War, we repay that by having strong economic growth. And strong growth leads to strong employment growth, which leads to additional tax revenues. This period of repayment here is often cited as due to the Snowy Mountains scheme, and it's not quite true. What caused that strong economic activity through to the end of the 1950s was the really strong population growth that we had. And that population growth was often employed building the Snowy Mountains scheme. So the Snowy Mountains scheme provided the employment, but not the growth. Likewise, out the other side of this, we're going to need, there are only three things that grow an economy. It's participation rate, which is largely about having women more actively engaged in the workforce. It's about productivity, which is really difficult to do. We've missed a decade of productivity growth because of the high value of the Aussie dollar, and we're going to miss another decade for the same reasons this time around. And the third reason is population growth, which is the easiest lever for governments to pull to help pull us out the other side of this recession. And I think that once we arrive at a level of a post-vaccine environment, we see a return to strong population growth in Australia. Quite how stable that is, I think we can certainly question, but it will certainly be one of the easiest levers for governments to pull us out of this recession. I'm going to skip over these slides here. They show our long-term forecasts, and the reason why we've downgraded our long-term forecast, it is because visa restrictions that came into place in 2017 have seen population growth slow. As a consequence of that, unless those visa restrictions are eased, then all of our forecasts have been shifted downwards. Now, I suspect that over the course of the next 12 months, we may see a new population growth regime. We may see the government returning and revising what their strategy is. I'm not saying that they're returning to a big Australia strategy, but that a return to attracting skilled migrants. And it's important to recognise that the migrants we are attracting are that narrow cohort of workers that are of working age and are coming with skills. They've typically studied in Australia prior to that, meaning they've also brought an element of wealth with them as well. We're missing that at the moment, and we have seen other countries move into the space and compete in that two-step migration pathway. But I suspect we will see a reversal of that very quickly when we're in a vaccine-related environment. And at that, Paul, I might start wrapping up and take any questions that you have. But as I've covered there, we have a very optimistic outlook for detached house starts. We have an optimistic outlook for renovations activity. We don't have a sharp fiscal cliff in our projections because households will start spending the money they've saved. And there are a lot of factors across the economy that are very positive. The risk of a rise in interest rates is certainly there, but at this stage, it's very difficult to see interest rates rising within the next 2 years. After that, it's certainly possible to see interest rates returning to long-term average, which should be north of a 3% interest rate. But at the moment, they're assisting the government in their ability to be able to borrow and borrow at very low costs. Over to you, Paul.
All right. Well, thanks, Tim. It's just fascinating that it's actually a lot more positive than I had thought. So, yeah, and that comment about kids not moving, to Sydney or Melbourne, it's fascinating. So, very interesting. All right. Well, obviously, so again, thanks, Tim. So now Tim's happy to stick around for some questions. So
we've got one here, Paul. Do you have any comment on the manufacturing, especially in the steel industry?
Yeah, so I fear that what we're going to see this time around is exactly what we saw after the GFC, which is after the GFC, the Australian dollar went to $1.10. At the time, I was working in the automotive manufacturing sector, and that was one of the final nails in their coffin. And you can see the dollar shifting up again now. And the Reserve Bank, the most recent cut to interest rates, they didn't do that to stimulate housing. They've seen these same numbers we're seeing. They did it to keep downward pressure on the Australian dollar. If the dollar rises, it just makes it very difficult for large foreign investors, particularly in manufacturing businesses such as steel, being able to invest into Australia because other countries around the world become a better return on investment. And so add to that high energy prices in Australia, and I can see it being challenging for Australia to attract investment. And that investment's really important to get that second P, that being productivity. You only improve productivity with new investment. And for us, that will come from overseas. So it is something that we keep flagging as a concern. And the only way around that is what we would term an interventionist industry policy, which is the federal government specifically targeting those manufacturing sectors to attract investment. The rest of the world did that after the GFC, and they did that to either attract automotive industry or other forms of manufacturing, and they do that through one of two ways. You either stimulate investment through R&D, which is an R&D tax concession of 150% or higher, or you do that by picking winners, and picking winners has been very unpopular in Australia. So I would like to think that next year we get back to talking about innovation and R&D. We had a cycle of that in 2000. We had a cycle of that in the late 80s. And I think that we're back to having that cycle again now that all of those R&D tax concessions have been wound down over the past 20 years. It's probably one of the better ways that government can spend their money in 2021.
Great. I have another question that was emailed earlier. How will equity pricing to consumers be affected if coal is removed or reduced from the market?
If coal?
Coal, yes.
Depends on your time frame. So coal is the lowest cost energy, or sorry, existing coal-fired power stations are the lowest cost energy that we have. And the problem that we're facing in the energy market at the moment isn't about generation. Replacing old coal-fired power stations is something that has to happen over the course of the next decade. They were built in the 1960s and 70s with the intention of lasting 30 years. They're now 50 to 60 years old, and they need to be replaced. But the challenge is that over the past 15 years, we have spent so much money on poles and wires that we have a very high retail price for electricity. And that is the very difficult one for governments to unpick. It occurred when governments owned the poles and wires. They've now sold them on the basis that there will be guaranteed returns. And it will take us at least another decade to unpick that. So in terms of coal, it's difficult to see that there will be investment in new coal generation to the same scale that we have in our present grid, and it will be replaced by alternative sources or what they call ultra supercritical, which is far more emissions efficient than the current fleet. But there will be a structural shift in terms of what that generation is, or what that generation capacity is. What's going on with the debate between Barnaby Joyce and Angus Taylor at the moment, I'm not quite sure of all of the background to that, but Newcastle, because of its historical density of coal and the Latrobe Valley, all of the poles and wires, the transmission network hub through those two regions, and they will continue to hub through those two regions, which means additional generation capacity will be built in regions that have a high volume of coal. That's not an issue in terms of switching fuel sources, because we can see from what's occurring this year that global demand for coal still remains very strong, and other regions, other countries around the world will use coal as a means of lowering their energy costs in order to attract that industrial activity. So I wouldn't see it as a negative for any individual region such as the Latrobe Valley or Hunter. In fact, I see it as a positive, because whatever generation capacity we're building will go into those regions.
Thank you. The next question I have is, I've heard certain parts in the manufacture of solar PV systems rely on minerals that have a limit locally sourced China implications. And then somebody has also commented and asked, what comments do you have regarding China? So.
Yeah, China's the really big one. Just before I get to the question about scarce resources, just going to throw to this chart here, not one of my own, but there is a very unique situation occurring with global trade at the moment. And so you can, all these lines here are all of the lines of what's happened to, this is a measure of 20-foot equivalent units or shipping containers. And you can see here, every year, roughly the same, some years up, some years down. And then we have 2020. What's happened this year, and right at the moment, there is a shortage of shipping containers globally. This phenomenon of it's not unlike the phenomenon of what happened with toilet paper in Australia at the start of the year. Things got a little short, and therefore people started stockpiling. The stockpiling causes its own shortage, which creates a little more panic buying. And this same dynamic that we've got in Australia is occurring in the United States. It's occurring in Europe as well. Those manufacturing businesses that ran short of some unique Chinese imported product are currently stockpiling that product in the United States while they set up alternative manufacturing capabilities. So we talk about multi-country sourcing. So if we take the automotive industry as an example, every vehicle, every large production vehicle is manufactured in multiple places around the world. Every component for those vehicles are manufactured in multiple countries around the world, which means that automotive companies can shift their production depending on when there may be economic crises or natural disasters that cause them to shift production. So is true of most volume building products. We do run some risks with some particular products, but likewise, you will be seeing a lot of manufacturing facilities increasing their capability to manufacture their products in areas outside of China. And that leads to this. Whilst they're doing that, they're stockpiling the resources they need to do to be able to increase production in regions outside of China. And they're storing that production in 20-foot shipping containers in the United States, which means shipping containers are going into the US and they're not coming out. Same thing's happening in Europe as well. So trade right at the moment is very challenging, and it will be until sometime after Chinese New Year. So we're looking at something more like March before we start to see this line here track back closer to the long-term trends. Now, the first question there wasn't that question, was it, Nat?
No, it's, what was it? I've heard certain parts of manufacture of solar systems rely on materials that have limited locally sourced.
Yeah, so graphite's certainly one of those. Now, particularly the region around Darwin and certain areas in WA do hold large shares of those scarce minerals, the rare earths, and that may lead to those mines becoming viable over the course of the next few years. I don't think it's a risk that we're running out of those rare earths at this stage. It's just that, like we've seen with gas over recent years, as the price increases, as it has, they start extracting gas from locations that weren't previously viable. And at that point, a number of the Australian mines start to become viable. Yep. So it may be a positive for us, if not from the generation perspective, from the mining perspective.
Excellent. Next question, what you think I think this is supposed to say, what do you think the Made in Australia will have on the market? thinking industrial and construction market?
I don't think it'll have a great deal of an impact. I don't think that consumers are going to go above and beyond to purchase Australian products simply for that logo. I do think manufacturers will start to invest outside of China, as I've mentioned, but unless unless the government is very active in encouraging that investment, then we will once again miss out on that wave of investment. And that's a concern.
That's it. I don't have any more questions. Does anybody have anything? No, that's it.
Bang on 11. Well done, Nat.
Well done, Tim. So again, Tim, thank you very much for your time. We appreciate that. I just find it fascinating to hear what's happening, and we're all in our own little bubbles. So to be able to think outside or listen to what's happening outside of our own bubble is, we don't get enough of it, I'm sure. So thank you, Tim, and to everyone that's dialed in. Really, again, thank you for giving up your time as it's very busy leading up to Christmas. And I hope you all have a very good Christmas, a safe Christmas, a busy trading Christmas, which I'm sure you will. And thank you very much for your time. So, thank you.
Thanks, Paul. See you soon.
Thank you.